Can just $5 a day turn into a six-figure investment? The answer is yes. Investing isn't about getting rich overnight. It's about consistency, discipline, and letting time do the heavy lifting. The concept of investing small amounts regularly and allowing compound interest to work its magic has transformed the financial future of many individuals. Whether you're just starting or considering boosting your savings strategy, understanding the long-term impact of even small investments is essential. In this guide, we'll break down a realistic case study of investing just $5 a day into index funds over 20 years. We'll analyze how compound interest, market volatility, and long-term strategy play a crucial role in wealth building. Ready to explore how a mere $5 per day could turn into a substantial investment? Let's talk in detail. Choosing the right investment platform. To make this strategy work effectively, choosing the right investment platform is crucial. With so many options available, it's important to focus on key requirements that ensure the best experience for long-term investors. Key factors to consider when choosing an investment platform. 1. Low fees. High fees can eat into potential returns. So selecting a platform with little to no trading costs is essential. Even a seemingly small percentage in fees can significantly impact your earnings over 20 years. 2. Beginner-friendly interface. Investing should be simple and intuitive, especially for those new to the market. A clutter-free, easy-to-navigate platform can make investing a seamless experience. 3. Security and protection. The platform must be backed by financial protection, like Securities Investor Protection Corporation, SIPC, in the US, which safeguards up to $250,000 in case of broker failure, not investment losses. 4. Low minimum deposits. Since we're investing just $5 a day, the platform must allow small contributions and automatic deposits. 5. Automatic investing. A feature that enables daily automated investments without manual effort is essential for maintaining consistency. Top US investment platforms for small daily investments: M1 Finance, commission-free investing, automated deposits, and fractional shares make it an excellent choice for beginners. Fidelity, no account fees, excellent S&P 500 index funds, and a beginner-friendly app for seamless investing. Acorns, ideal for beginners. Acorns rounds up your purchases and invests spare change automatically. Charles Schwab offers low-cost index funds, automatic investing, and SIPC protection. Vanguard, a leader in index fund investing with low-cost ETFs and long-term growth potential. Each of these platforms supports low-fee, automatic investing with the ability to start with as little as $5 per day. With the right platform in place, the next step is choosing the right investment strategy. The $5 a day investment plan. Rather than picking individual stocks, which can be risky and require extensive research, we'll use index funds, specifically the S&P 500, which tracks the performance of the 500 largest U.S. companies. Historically, the S&P 500 has averaged a 10% annual return. However, the stock market does not always go up in a straight line. There are years of losses, market crashes, and recoveries. But through disciplined investing, time has proven that the market tends to grow over the long term. Why the S&P 500? 1. Diversification. Instead of betting on a single company, you're investing in 500 top-performing businesses. 2. Long-term growth. Over decades, the S&P 500 has consistently delivered strong returns despite short-term volatility. 3. Low maintenance. Investing in an index fund eliminates the need to actively manage a portfolio, making it perfect for long-term investors. Year-by-year growth. The impact of market ups and downs. Instead of assuming a steady 10% return every year, let's add realism by including some market downturns. Here is a breakdown over 20 years, assuming various market returns. Including some years with losses. Key takeaways from the investment table. Losses do happen. Some years had negative returns, but the portfolio still recovered and grew significantly. Compounding still wins. Despite downturns, the portfolio ended with nearly triple the amount invested. Time smooths volatility. Long-term investing overcomes short-term losses and market fluctuations. Breaking down the power of compounding. Compounding isn't just about linear growth. It accelerates over time. By year 10, the portfolio is around $27,000. Just 5 years later, year 15, it grows to $32,000. By year 20, it surpasses $100,000 despite losses along the way. Final thoughts: why this strategy works. Even with losses. Investing $5 a day might not seem like much, but over time, it leads to life-changing wealth. Here's why. Small amounts add up. Even a modest daily investment can turn into six figures with consistency. Market downturns are normal. Corrections, crashes, and volatility happen, but they don't stop long-term growth. Compound interest is powerful. The earlier you start, the more time works in your favor. Automating investments removes emotions. Setting up an automatic $5 daily investment eliminates emotional decision-making. Time in the market beats timing the market. Instead of predicting highs and lows, staying invested leads to success. Now let's recap what we have learned so far. Investing often seems intimidating, especially for beginners. Many people hesitate to start because they believe they need a large sum of money to make a difference. However, this is far from the truth. The reality is that even small, consistent investments can grow into substantial wealth over time, thanks to the power of compound interest. One of the biggest misconceptions about investing is that you need a lot of money to see real returns. But the truth is, even a modest daily investment can turn into six figures with consistency and time. For example, let's say you invest just $5 a day into the stock market. That's $150 per month and $1,825 per year. If you consistently invest that amount and achieve an average annual return of 8%, which is close to the historical average return of the S&P 500. Here's how your investment could grow over time. 10 years about $27,000. 20 years about $82,000. 30 years about $227,000. 40 years about $587,000. By simply investing $5 per day, you could potentially build a portfolio worth over $500,000 over the course of 4 decades. And if you increase your daily investment to $10, $20 or more, your returns will be even greater. This is the power of consistent investing. Small contributions may not seem like much at first, but over time, they compound into something significant. Market downturns are normal. Many people avoid investing because they fear market crashes or short-term volatility. However, downturns are a natural part of the market cycle. While nobody enjoys seeing their portfolio decrease in value, it's important to understand that market corrections, crashes, and fluctuations are normal, and they don't stop long-term growth. Consider the history of the S&P 500. It has experienced countless market crashes and bear markets, including the Great Depression, 1929, the dot-com bubble, 2000, the Great Recession, 2008, and the COVID-19 crash, 2020. Despite these setbacks, the market has always recovered and continued to grow over time. The stock market has historically delivered positive returns over the long run, making it one of the best wealth-building tools available. For long-term investors, the key is to stay invested and not panic during market downturns. Many of the biggest market gains happen shortly after a crash, so trying to time the market often leads to missing out on major opportunities. The best approach? Keep investing consistently, regardless of market conditions. The power of compound interest. If there's one concept that every investor should understand, it's compound interest. This is the phenomenon where your money earns interest, and then that interest earns interest, creating exponential growth over time. To illustrate, let's compare two people. Person A starts investing at age 20, contributing $200 per month until age 60. Person B starts investing at age 40, contributing $400 per month until age 60. Both invest a total of $96,000. However, because person A started earlier, their portfolio will be significantly larger by retirement, potentially over twice as much as person B's portfolio. This demonstrates why starting early is crucial. The longer your money is invested, the more time it has to compound and grow exponentially. Even if you're in your 30s, 40s, or beyond, it's never too late to start. The best time to invest was yesterday. The second best time is today. Automating investments removes emotions. Investing can be emotional. When the market is doing well, people feel confident and excited. When it drops, fear takes over, leading many to sell at a loss. The best way to remove emotions from investing? Automation. By setting up an automatic investment plan, you eliminate emotional decision-making. Whether it's $5, $10, or $50 per day, automating your investments ensures that you stay consistent. No more forgetting to invest or waiting for the perfect time. Take advantage of dollar-cost averaging. Buying shares at different prices reduces the impact of volatility. Avoid emotional reactions. No panic selling or second-guessing market movements. Most brokerage accounts allow you to set up recurring investments into ETFs, index funds, or individual stocks. This is one of the simplest and most effective ways to build wealth over time. Time in the market beats timing the market. Many investors try to predict market movements, buying low and selling high. However, studies consistently show that timing the market is nearly impossible to do consistently. Instead of trying to guess when to invest, it's better to stay invested for the long haul. Here's why. Missing just a few of the best market days can significantly reduce returns. Historically, the stock market's biggest gains often happen within days or weeks of major downturns. If you're out of the market when these gains occur, you could miss out on massive growth. Long-term investing smooths out volatility. While the market moves up and down in the short term, the long-term trend has always been upward. Investing consistently leads to better outcomes. Instead of trying to buy the dip, focus on regularly investing, no matter what the market is doing. The takeaway? Time in the market is far more important than timing the market. The longer you stay invested, the better your chances of achieving strong returns. What's next? Start your investing journey today. If you've been waiting to start investing, the best time is now. Whether it's $5, $10, or more per day, the earlier you begin, the greater your future rewards. Here's how to get started. Choose a brokerage account. Options include Fidelity, Vanguard, Charles Schwab, or apps like Robinhood and M1 Finance. Pick an investment strategy. Consider index funds like the S&P 500, ETFs, or dividend stocks. Set up automatic contributions. Decide on a daily, weekly, or monthly amount to invest. Stay consistent. Ignore market noise and stick to your plan. Keep learning. Follow financial education resources and adapt as needed. Your future self will thank you. What's next? If you've been waiting to start investing, the best time is now. Whether it's $5, $10, or more per day, the earlier you begin, the greater your future rewards. What's your investment strategy? Drop your thoughts in the comments below. If you found this helpful, don't forget to like, subscribe, and share to help others start their investing journey.